will be preparing. So they must be as per the requirements of the Companies Act, or basically they must conform to the requirements of the Companies Act. So that's why basically most people basically, for example, registering a private company, they'll opt to use the model articles under the Companies Act, because even if you are to prepare on articles, they must be in conformity with the requirements of the Companies Act. In this regard, we mean, for example, if there are procedures as to how, for example, a director should actually be appointed, when you are coming up with those articles of association of viewers, those procedures must be as per the requirements of the Companies Act. So if you look at the Companies Act, they have given guidelines as to how you can actually be able to appoint a director in a company. So if you are preparing on articles, they should actually basically be in conformity with what is actually required under the rules and guidelines regulating operations of companies in Kenya. So that is the Companies Act of 2015. So you said once you prepare these particular documents, then you can fill out a statement of nominal capital. So that particular statement of nominal capital will actually be revenue stamped. And in this case, we said, for example, if you are registering the company for the first time, you won't pay the stamp duty. But if you are to increase the share capital later on, you'll be required to pay a stamp duty to the Kenya Revenue Authority. So that is basically the requirement in terms of the memorandum articles and the statement of nominal capital. So you said, apart from those documents, also, you will fill out this particular form known as Form CR8. This will basically give out the residential addresses of the directors. So in this particular form, you'll be required to fill out the residential addresses of the directors of the company. It's another requirement when you are registering your company. So residential address of the directors of the company will basically be filled out on Form CR8. After that, basically you'll fill out Form CR1. So now that is the form that will basically be applying, will be like an application for registration of the company. So then you'll attach the documents of the directors in terms of the pins, KRA pins, copies of IDs, so copies of KRA pins, copies of IDs, passport size photos. So we'll basically attach all those particular documents together with those particular forms to the Registrar of Companies. And therefore, what will happen at the registrar's office, he'll be able to assess those documents you've submitted, all of them. If basically they are as per the requirements, you've submitted everything that is actually okay, so he assesses the documents, the Registrar of Company assesses the documents, and ascertains that these documents are actually okay, the Registrar of Companies will be able to give out or issue out what we call a certificate of incorporation. A certificate of incorporation. We'll issue out or give out what we call a certificate of incorporation, a certificate of incorporation. So I want us to basically pick up from that particular point of certificate of incorporation, certificate of incorporation. So that particular point of certificate of incorporation. That particular point of certificate of incorporation. So you say that you met all the requirements. You'll get a certificate that will basically indicate or clearly indicate the company has actually been incorporated. So what will be part of the contents? So most importantly, just to know also the contents of this particular certificate of incorporation. So it will basically outline the name of the company, name of the company, name of the company. It will outline the name of the company, name of the company. It will outline the name of the company. Also, we say that it will indicate the date of incorporation of the company, date of incorporation, date of incorporation of the company, date of incorporation of the company will actually be there. Also, what will be indicated there will be, it will be signed by the registrar of companies. It will be signed by the registrar of companies. It will also have a unique business number. It will have a unique business number. It will have a unique business number. Also, it will have the common seal the common seal of the registrar, common seal of the registrar of companies, common seal of the registrar of companies. So this will be part of the contents or what will be contained in the certificate of incorporation. And I think there's one of us who actually sent a copy of a certificate of incorporation. If you look at that particular certificate of incorporation, you'll be able to see. Monica, you can mute yourself. So the common seal of the registrar of companies, the common seal of the registrar of companies. So this will be part of the contents of what will be contained in the certificate of incorporation. So it is important you know it because in the exam, they can test and basically require you to in the exam, they can test you and basically require to give the requirements with regard to a certificate of incorporation. So the point I want to make here is that once the register of companies has given out this particular certificate of incorporation, it basically clearly will indicate that the company has been given the right to be able to commence business. So that date on the certificate of incorporation is actually very important. It is actually very important. It is basically the date under which the company has the rightful mandate to be able to commence business, So that is, even if, for example, it has not been signed, maybe by the register of companies, maybe due to a mistake, so long as that date has been indicated. So for example, if it is maybe 10th of January, so the company will have the right to be able to commence business immediately 10th of January, even if there's actually evidence that maybe this certificate of incorporation was actually basically signed maybe 2 days later or 3 days later by the register of companies. So the date is actually very important on that particular certificate of incorporation. The date is actually very important. So maybe just to put up the emphasis with regard to the dates, with regard to the certificate of incorporation. So there's a particular case law that talks about, I can see Monica is saying it is raining. So I'm recording the class. Hopefully we'll get the video later on. I've seen your message. I'm recording the class. So after the class, maybe you'll get the video. But there's a case law that I want to share basically that puts emphasis on the importance of the dates on the certificate of incorporation, the importance of the dates on the certificate of incorporation. So let's see if I'll be able to get it. So you can see there the conclusiveness of the certificate of incorporation. So why is it very important for this certificate to be given? And the date of incorporation, why is it very important on the certificate of incorporation? So you can see what they're saying there. Once the certificate of incorporation is issued by the registrar, it shall be conclusive evidence that the requirements of the Act in respect of registration and matters precedent have been complied with, and the association is a company authorized to be registered under the Act, and nothing is to be inquired as to the regularity or otherwise of prior procedures of incorporation. So prior procedures of incorporation won't matter here. Even if you didn't submit a particular document and you've been given this certificate, it is conclusive evidence you can be able to commence business as a company. Even if you missed out on one document, but the registrar didn't actually realize. So hiyo ni shauri yake. So long as amekupatia certificate, you can be able to commence business. So once this certificate has been given, it is conclusive evidence the requirements with regard to registration of the company basically have been met, and therefore the company can actually commence business, because they are saying that it doesn't actually require to inquire more about the regularity in terms of the requirements in terms of the registration of the company. So once the certificate has been given, the company can commence business. So there's that case law that is actually very important, the one I want you to be able to pick up what comes out in that particular case law. It talks about Jubilee Cotton Mills versus Lewis. So it says Lewis was a promoter of a company for the purchase of cotton mill. The memorandum of association and the articles of the company were accepted by the registrar. So that date is important. The registrar on 6th of January 1920. And the certificate of incorporation was dated the same date. So you can see what actually happened. The certificate of incorporation was actually dated the same date. So it was actually 6th of Jan, the year 1920. There was, however, evidence that the registrar signed the certificate on 8th of January. So you can see what actually happened. So 2 days later is when the registrar actually signed the certificate of incorporation. So 8th of January is when the certificate of incorporation was actually signed. So after 2 days later, even though the date on the certificate is 6th, but it was signed 2 days later. On 6th of January, so you can see on that particular date that is indicated on the certificate of incorporation, something happened in the company. On 6th of January, a number of fully paid shares were allotted by the company. The question arose, so that was the question before the court. The question arose as to whether allotment of shares was actually valid. So that means it's like the company has commenced business, so they're allotting shares. So the question arose as basically to whether that allotment was actually valid, because there was the question as to basically the certificate having been signed 2 days later. So this was what was actually ruled before the court. It was held that the certificate was conclusive evidence as to the date on which the company was incorporated. The allotment was therefore valid. So the issue of shares on the 6th of January, even before the certificate had been signed, was actually valid. So it simply means that the company had the rightful mandate to be able to commence business, because the date indicated on the certificate of incorporation is actually 6th of January. So that's what you are saying, the date is actually very important. So it doesn't matter that mistake by the registrar to sign the certificate later. It doesn't matter. The company had the rightful mandate to commence business and actually be able to allot shares So that is actually very important. So that particular case law is actually very important, because maybe they can bring a scenario in the exam. So they just basically change the names of that particular case law. They say that this company ABC, this company was incorporated on 6th, but the certificate was signed 4 days later. On that particular date of 6th, maybe the company did a particular something, they did something in the company that basically regards maybe business to do with the company. So they ask whether that particular business was actually valid or not. It's so long as valid, because the date indicated on the certificate of incorporation is the rightful date that the company can actually be able to commence business, So we've basically seen how you can be able to incorporate or register your company. So what actually happens later on after you've registered your company? So there are certain requirements that you must actually be able to meet. So once you register your company, you'll, for example, be required to ensure you'll do certain things. For example, you'll open a bank account. For example, in this case, if you want people to manage your business, you'll likely be able to ensure there are people to manage your business. You'll start keeping the books of accounts. You'll, for example, start remitting the required returns to the registrar of companies. So there is what we call post-incorporation requirements that must be met by the company. So you'll end up, for example, opening a bank account for the company, ensuring you maintain the proper books of accounts. If basically you don't have directors to manage your business, you can appoint some to be able to manage your business. You will start remitting returns to the registrar of companies each and every year. So apart from those particular returns to the Kenya Revenue Authority, also there are returns that must actually be submitted to the registrar of companies each and every year. So we learn about these particular returns when we'll be looking at the topic of the company secretary. So apart from the returns to the Kenya Revenue Authority, other returns must actually basically be submitted to the registrar of companies each and every year. So failure to submit the returns, then of course you can be penalized. You can actually be penalized or be asked to pay a fine. So part of the requirements post-incorporation requirements. Post-incorporation requirements. So you can talk about appointment of directors, You can talk about maintenance of books of accounts. can talk about opening a bank account. Opening a bank account. Opening a bank account. You can open a bank account. Another thing that will be there is maintenance of the company registers. Maintenance of the company registers. You can give an example, i.e., for example, members register, comma, you can talk about directors registers, comma, you can talk about company secretary registers, We'll learn about registers later on. We'll come across them in several topics. So when you talk about, for example, a register of members, so this simply just like a documentation of all the members of the company. So you are required under the Companies Act as a company to ensure you maintain this particular register. Also, when you talk about register of directors, it simply basically gives the details of the persons who have been directors of the company, past and actually present directors. Company secretary, it gives basically details of the persons who have been the company secretaries of the company. So their residential addresses, their names and addresses, all those will actually be maintained in a company secretary register. So once you incorporate the company, it is part of the requirements that you'll be able to maintain all these registers at the registered office of the company, So another thing that will actually be required in this case, for example, the company will be required to have what we call a common seal. So you'll see people are ensuring that the company has a stamp. So you can use a common seal, or other people just use what we call a stamp. So people are used to using a stamp. So the company will have to have this one to be able to authenticate its documents. If you give out a receipt, you stamp. If you give out any formal document like a letter, you stamp, or you use what we call a common seal. So a seal is that one that basically doesn't have the ink, but you can be able to press and actually appears in the document. So that is what we call a common seal. So another thing we've said we can be able to say is that the company will have to ensure, so it maintains a bank account, appointment of directors, maintenance of company registers, common seal. You can actually be able to say also making annual returns to the registrar, making annual returns to the registrar of companies, That will be part of another requirement the company must be able to meet after being registered. So I've tried to explain what is that particular return. So there's a return that is normally made to the registrar of companies each and every year. So it basically outlines, for example, the status of the company. Remember, when you're registering the company, maybe you registered it with maybe certain directors. So maybe there has been change of directors, there's been change of memberships. You must actually be able to update your records at the registrar's office. So it is important you make this particular return each and every year. Another thing that will be required, for example, is maintenance of minutes books. What we mean by minutes books is the company will actually operate by being able to hold meetings. So in those meetings, for example, members meetings at the annual general meeting, you've seen companies hold AGMs or just a general meeting like a board of directors meeting. So there are normally minutes that are supposed to be maintained by the company secretary. So it'll have to maintain what we call minute books, so that if there's any reference to past minutes, it will become very easy. So maintenance of minute books, maintenance of minute books will be part of the other requirement, the company must actually be able to ensure. Another thing is use of the company name in all its documents. So use of the company name in all its documents, use of the company name in its documents. So you'll see after you register the company, when you are doing a receipt, you put like the logo of the company there and the name. If you are doing an invoice, you put like the logo of the company and the name. If you are doing a formal letter, you put on a letterhead, it has the company's name and all the details. So that will be part of the requirement that you must ensure after you basically registered your company. So use of the company name in its documents or in its documents that are being issued out by the company. So that will be part of the requirements. Part of the requirements with regards to post incorporation after you get the certificate of incorporation from the registrar of companies. So I want us to look at in deeper details the memorandum of association. We want us to look at in deeper details the memorandum of association. Then we can look at the articles of association. Then we'll have wound up with this particular topic. So memorandum of association. So we've said this particular document is the one that will actually try to explain or talk more about the company to the outside world. So in this case, what do we mean by that? If you look at this particular document, you'll be able to tell more about the company. Maybe who are the owners? For example, what is the main objective as to why the company was actually formed? What is the registered office of the company? So this particular document will be able to outline those details with regard to the company. That's why you are saying it basically explains or talks more about the company to the outside world. So you as a third party outside there, you can be able to tell more about the company if you look at this particular document. So you say that the normal memorandum of association will basically contain what we call clauses, or we can say by clauses we just mean, for example, like paragraphs. So what will be there, for example, will be the name clause. Also, we'll have what we call the objective clause. Also, what will be contained there? So clauses are just like paragraphs. Liability clause. Also, what will be there is the registered office clause. Also, what will be there is the share capital clause. Also, what will be there, maybe you can say, talk about association clause. So these are normal memorandum of association. But we've said, so this is like the one that was actually basically being prepared under the previous Companies Act. So in this case, we are saying that these details can basically be captured by either form CR1, CR2, CR3, or CR4 as per the current Companies Act. So all these details can actually basically be captured in these particular forms that are basically remitted when you are registering your company. So when you talk about the name clause, for example, if the memorandum, normal memorandum, so the name clause basically talks more about the name of the company. So there are certain requirements that must be met with regard to, let's say, for example, with the name of the company. So in this case, when you are seeking to register the company, they won't just accept any name. So you must actually be able to meet the requirements with regard to the name. So what are these requirements with regard to the name? What are these requirements with regard to the name? For example, if you're registering your company, you must not use a name that is too similar to that of an already existing company. So when you are remitting the name, or basically you are searching for the name, you must remit a name that is not too similar to an already registered or existing company. Otherwise, if you do that, basically the registrar won't actually accept such kind of a name. So number one importance with regard to the requirements, with regard to the name, when you're seeking for registration, is that the name must not actually be too similar. For example, let's say, for example, if you go to seek for a name like Safaricom, so they won't actually basically register your company with the name Safaricom because Safaricom is already in existence. You must look for a very unique name. So the requirements, number one, with regard to the name when you're registering your company, the name should not actually be too similar to that of an existing company. Number two, So the name shouldn't actually be misleading or actually confusing. Let's say, for example, if you register a company with the name ABC Auto Spares, ABC Auto Spares. So you registered your company like this, but of course, the objective of the company is to bake cakes or maybe bake bread. It is actually involved in baking of cakes. You can see this particular name is actually very confusing. So if you look at this particular name in the first instance, you'll basically conclude that this company deals in sale of spare parts, or maybe something to do with motor vehicles or spare parts of motor vehicles. It doesn't actually basically relate to a basically objective of actually carrying out a business like doing maybe cakes. So the name should actually basically not be misleading or confusing to the public, or basically members of the public or those people who actually associate with the company. So you've said, number one, the name shouldn't actually be too similar to that of an existing company. Number two, the name shouldn't actually be confusing or misleading. I've given an example. If, for example, you register a company known as ABC Auto Spares, yet the objective of your company is to bake and sell cakes, so that particular name won't actually basically be registered or actually accepted by the registrar of the company. Number three, another name that wouldn't actually be accepted is, for example, if you use a name of a person who isn't actually even a director in the company. Let's say, for example, in this case, it's me who is registering the company. So that is Mr. Job registering the company. And of course, he ends up using a name, let's say, for example, of Bob. So Bob is not actually even a director in the company unless I give a special reason. I give a special reason as to why I'm using Bob's name. Then they can actually be able to accept to register the company with such kind of a name. So you can't use a name or a proper name of a person. You can't use a proper name of a person who is not a director in the company, because maybe you are just taking advantage. That particular person is maybe very famous or very popular. So you want to use his name to register the company. So unless you give a special reason to the register of companies as to why you want to use a proper name of a person who isn't a director, they won't accept such kind of a name. So if, for example, if it's me to register the company, so maybe I can use my name, and of course I should actually be a director in that particular company. That's when the registrar will easily accept for such kind of a company name to be registered. So number three, we are saying you cannot use a proper name of a person who is not a director in the company unless you give a special or proper reason. You give a special or proper reason. So another thing, number four, with regard to the name, is that you cannot use a name that has any connection to maybe the office of the president, or we can normally say to the presidency. So if there's any name that is basically has any connection or relation to the office of the president, also such kind of a name won't actually be accepted. Then another thing is that those names that have been prohibited or basically maintained under the National Emblems and Flags Act. So any name basically in any emblem or under the flag of the, or in Kenya, let's say, for example, certain names like, we have names like Jamhuri, Nyayo. So there are certain names that have basically been prohibited or basically maintained under the National Emblems and Flags Act. So you can't just use such kind of names to be able to register your company, So unless there's actually maybe a special reason, or basically there is actually an acceptance or been given the permission by the government. So those names maintained under the National Emblems and Flags Act cannot actually basically be used to register your company, So with regard to the name, those kind of names cannot actually be accepted to be registered by the registrar of companies. So maybe they could ask which kind of names cannot actually be registered with the register of companies. So those are basically some of the names. So if it is too similar to that of an existing company, if the name is actually confusing, if you use a proper name of a person who is not a director, if the name has been prohibited under the National Emblems and Flags Act, let's say, for example, if such a name has any connection to the office of the president or the presidency, then such kind of a name won't actually be accepted. It won't actually be accepted. So once you basically registered the name, you'll be required, part of the requirements. Someone has a question.
Yeah.
Yes, you can ask.
There's one there's one I saw that they said about a name with Kenya, like they can't accept it.
A name with it?
Kenya, like Kenya, the country.
So those are the names I think I'm saying that they are actually under the National Emblems and Flags Act. So such kind of names that are basically being maintained, it's like they are names that are actually owned by the state. So names that are basically owned by the states. You can't use such kind of names in registering your company. So unless maybe there's a special reason or maybe there's a special acceptance, then you can use such kind of a name. So such kind of names cannot actually be used to register your company. So they have basically been prohibited or protected. So it's like a national emblem. It's like a name that is actually owned by the state. So you can't use such kind of a name to register your company unless there's a special reason or maybe there's a special acceptance by the state. So we are saying once you've basically gotten the name, so there are certain requirements with regard to the name, apart from those ones when you are registering the name, that when you have your name now, this name basically has to be displayed conspicuously in your business premises. So that's why when you go to, let's say, for example, any company's reception, so the name is actually clearly indicated there. This company is known as this and this. Maybe outside the building, the name is actually there. So it must actually basically be displayed in a place that is actually very visible in your business. Then, for example, if you issue any documents, any form of documents of the company, so the name should actually be able to appear there. So it is part of the requirements under the Companies Act that the name should actually be displayed in a very conspicuous place within your business premises, like at the reception, maybe at the entrance. You should actually be able to see the name of the company. So it is a requirement under the Companies Act. Also, any documents issued by the company, they should actually be able to bear the name of the company. So certain times, there could be certain reasons that can actually make a company maybe to change its name. So sometimes the company can be able to change its name. So for example, if it was registered as ABC Limited, at a particular point, they might decide to change their name. But before you change the name, maybe there could be reasons that can actually be able to make you to change the name. For example, number one reason that can actually make the company decide to change its name, and I think this one you've seen it happen. So there's a company that has changed its name like 4 or 3 times. So this company, I think it was known as, is it Zane, Celtel, Zane, Kensel. It has basically changed its name for a number of years, and currently it is now actually known as Airtel. So what are the reasons that can actually make a company decide to change its name? So in this case, for example, if the register of companies inadvertently made a mistake and actually registered your name, the name of the company, yet the name is actually already in existence, then he discovers later, he can of course be able to ask the company or basically give out an order to the company to change its name. So it can be due to inadvertency or basically a mistake by the register of companies by registering a name of a company that is actually already in existence, but he discovers later. So you can give out an order to the company to be able to change its name. So that is reason number one. Reason number two is through what we call passing of action. By passing of action, let's say, for example, another company outside there goes to the court and of course complains that there's a company that is using a name that is too similar to ours. Then it basically ends up winning the case, or basically the court ruling that your company should actually be able to change the name because it is too similar to that company that is actually complaining before the court. If they win the case, then of course the company has no option but basically to change its name. So that's what we call passing of action. So if there's a complaint before the court, so through passing of action, if there's a complaint before the court by another company that there's a company outside here using a name that is similar to ours, and there's actually evidence, we register the company before them. In such a case, if they win the case, it simply means that that company that is using the name of another company should actually be able to change its name. Another reason, it could be voluntarily. Just voluntarily decide, hii jina haitubambi, wacha tubadilishe, hii jina haitubambi, haiconnect na our customers, haitubambi kabisa, let's change the name. So voluntarily, through an ordinary, or through what we call a special resolution, through what we call a special resolution, the company can actually be able to change its name voluntarily. What we mean by a special resolution Hii inamaanisha kwamba the members of the company, wale wenye kampuni, the shareholders of the company have been able to meet at a general meeting and they have passed a decision. They have passed a resolution that the name of the company should actually be changed. So that is what we call voluntarily. Ni wenyewe tu mnaamua, we want to change our name. So you voluntarily change the name. So that is another reason that can actually be able to make a company to change its name through passing of a special resolution. What we mean by a special resolution, it is simply a decision that basically requires at least 75% of the members who are actually entitled to come and actually vote at such kind of a meeting to be able to approve. 75% and above. If it is 60%, that decision won't actually go through. If it is actually 55%, it won't go through. It is actually a special resolution. So let's say, for example, in this case, if the company wants to change the name and it has only been approved by those who actually basically control a voting right of only 60%. So the company won't actually basically change its name because it has not actually been approved through what we call a special resolution. So it must actually be approved by at least 75% of members who are actually entitled to actually attend and actually vote at such kind of a meeting. So we've said reasons as to why the company can change the name. Number one, we are saying voluntarily. So voluntarily through what we call a special resolution. Number two, we are saying if the registrar inadvertently made a mistake while registering the company and registered the name that is too similar to an existing company. Number three, we are saying through passing of action, whereby another company has complained before the court that there is a company using a name that is too similar to theirs. In such a case, if they win the case before the court, the company will actually basically be obliged to change its name. So those are the reasons that can actually be able to make the company to change its name. So those are basically the main points you should actually be able to gather with regard to the name clause. So they are likely maybe to test the reasons as to why the company can change the name. They're likely to test some of the names that won't actually basically be accepted, or basically what are the requirements in terms of names when you are registering the company. So they are likely to test such. Objective clause, nothing much to be able to discuss about this one. The objective clause basically just gives the reason as to why, the major reason as to why the object. What was the main reason as to why the company was actually formed? It will basically give the main reason as to why the company was actually formed. The objective of the company. Is it maybe to do mining? Is it maybe to carry out a particular business activity? What is the main reason as to why this particular company was actually formed? You can be able to tell it from the objective clause, So before we discuss the liability clause, so there is what we call the registered office clause. What is the registered office of this particular company? Is it maybe in Nakuru? Where is their office? Is it maybe in Nakuru? So because each and every company must have its registered office. So the part of the requirements that must actually be filled out when you're registering your company, that basically where is the exact location of the registered office of the company. So each and every person will basically ask, where is their offices? So where is their registered office? Is it maybe in Nakuru? Is it in Kisumu? Along which street? Under which building? Which floor? Which room? So basically the registered office clause will give the details to do with the location of the registered office of the company. Liability clause. So the liability clause basically outlines the liability of the members. Is it a limited liability? Do members of that particular company have a limited liability, or they have what we call unlimited liability, or they have what we call unlimited liability? So the company will be required to be able to ensure it follows what has been stated under the liability clause. If the liability of the members is actually limited, then it should actually be able to observe that it is actually limited up to what extent. Either maybe by the number of shares you hold in the company, or maybe by the guarantee you've given as to how much you can contribute towards the assets in case the company is actually liquidated. Yani madeni za members wa hiyo kampuni zinafika kiwango gani, itakuwa explained in this particular clause. And basically when I talk about a limited liability or unlimited, at this particular point, you should have an idea of what the teacher is actually meaning. To what extent is your liability in that company? You as the owner, or you as the shareholder, or you as the part of the key stakeholders, what is the extent of your liability? Deni yako kwa hiyo kampuni inafika kiwango gani. Tukisema deni yako, we mean basically you are the owner of the company. It simply means that if something happens in the company and the company is obliged to pay, utakuwa ndani ya hiyo mix. So ukikuwa ndani ya hiyo mix, itakuwa up to which extent? Because we said, for example, if you hold 100 shares, you own 100 shares of the company. Hii ndio kiwango una own kwa hiyo kampuni. Inamaanisha kwamba kama kuna madeni, you can be able to go to this particular extent to finance those particular liabilities. So in this case, this particular clause will actually be able to outline as to what is the extent of the liabilities of the members of the company. So if you look at this particular clause, you'll be able to tell such. So what I can be able to mention, maybe under certain circumstances, your liability as a member of the company can be increased, but the company won't just increase without any authorization, because it is clearly known that, let's say, for example, in this case, Elizabeth owns 100,000 shares of Safaricom. 100,000 shares of Safaricom. It simply means that Elizabeth's liability is actually worth the 100,000 of shares she actually owns in Safaricom. They won't go beyond that particular limit. So that particular limit will basically clearly be outlined in the liability clause. In this case, if Safaricom is actually liquidated, Elizabeth will basically only be called upon to be able to contribute only the 100,000 worth of shares to pay the liabilities of the company, kulipa madeni za hiyo kampuni, because that is what you've actually invested in the company as the owner. And therefore, if this particular company is actually obliged to pay its liabilities, you will only be called upon to be able to contribute towards the assets what the amount you contributed in terms of share capital. So that's the share capital you injected in the company. It is the one that will be utilized to pay the liabilities. And we said, for example, in this case, on liquidation, the company does not shut the door. There's a process. Part of the process is to pay the liabilities. So you as Elizabeth, basically, the amount you'll be able to utilize to pay the liabilities during liquidation or when the life of the company is to come to an end is up to this particular extent. It has a limit up to this particular extent. So they won't go beyond this limit, for example, if the company is a limited company. But of course, we said if it is unlimited, in this case, Elizabeth basically they'll consume the 100,000. And if the company is unlimited, they'll even call upon Elizabeth to bring even that motor vehicle at home, which he personally owns in his or her name, to be able to be utilized to pay the liabilities of the company. But of course, if the company is limited, there's an extent, there's a limit as to where they can actually be able to go in terms of calling upon you as a member of the company to pay during the liquidation of the company. But if it's actually unlimited, then it simply means that they can attach your personal assets for you as a member of the company in paying the liabilities, let's say, for example, on the liquidation of the company. So that particular clause will actually be able to explain what is the extent of the liabilities of the members of the company. And the company cannot just increase the liability of a member without following the proper requirements or procedures. So in this case, let's say, for example, if they are to increase the liability of Elizabeth from 100,000, so they must actually basically seek authorization, and this particular authorization must actually basically be approved by Elizabeth as a member of the company. So the company can only be able to increase the liability. Let's say, for example, if that particular member of the company has in writing consented or actually accepted to his or her liability to be increased. A number two way of how the liability can be increased is, let's say, for example, if you acquire more shares in the company, you are increasing your liability. Let's say, for example, in this case, if Elizabeth acquires 100,000 more shares, the liability will basically increase to 200,000. So by acquiring more shares in the company, your liability as a member of the company actually increases. Because in this case, when the company is to be liquidated, if you are actually 200,000, they'll basically consume this 200,000 towards the share capital to pay the liabilities. If she goes ahead and actually basically also buys more shares and goes up to 400,000, the liability of Elizabeth has actually also increased to 400,000. In case of liquidation at that particular point, this amount of Elizabeth worth of the shares will be the one that will be utilized to pay the liabilities of the company. So by acquiring more shares in the company, the more the liability of a member actually increases in the company. So through a written consent, so number one, through a written consent, the liability of a member can actually be increased. through acquisition of more shares, it simply means that your liability as a member of the company can actually also be increased. Then when you talk about the share capital clause, so this basically talks more about the share capital of the company. For example, what is the nominal capital of the company? What is the registered capital of the company? What is the registered capital of the company? And of course, the company can decide to manipulate this particular share capital in a number of ways. For example, they could decide they can reduce it. So they can do share capital reduction. Let's say, for example, if the share capital of the company that has been acquired or that has been distributed is maybe 1 million. So they can decide to reduce it maybe to 800,000. So we'll see later on as what are the procedures of reducing the share capital of the company. Let's say, for example, if the company has in excess capital, in excess of the needs of the company. So money is just lying there. So they don't have anything to be able to use for the money. They can decide to reduce the share capital. If this share capital has no assets that are representing the share capital, they can also decide to reduce the share capital. So they can either reduce the share capital, they can even increase from 1 million to 1.5 million. So that means the company maybe wants to venture into certain projects which they don't have enough money. So they can simply float out shares. So they can simply float out shares or sell out shares or invite members of the public to buy the shares of the company and increase the share capital from 1 million to 1.5 so that the extra 500,000 can be invested in a particular project that the company requires money to be able to carry out that particular project, because that is the only way they're actually able to raise their capital. So capital is basically used to run the business activity. So they can increase it from 1 million to maybe 1.5 or maybe even 2 million. It just depends with what are the requirements of the company. So they can even opt to maybe split the shares. Let's say, for example, in this case, if the shares of the company are this way, we have maybe 1 million shares, each going for 10 shillings. And this basically contributes to a share capital of 10 million. So they can decide to split the shares. So split them in a ratio of 1 to 2, such that in a ratio of 1 to 2, they basically increase them and the shares come up to 2 million. But of course, this particular price will reduce up to, each will actually go at 5. The value of each share will reduce up to 5. And of course, you get actually your 10 million. Or they can decide to merge or do the opposite now. If it is going at 5 shillings, they reduce the shares to 1 million and each one actually going by 10 shillings. So it will basically just remain the same share capital. So they can split the shares or maybe decide to merge the shares. So they can be able to manipulate the shares, the share capital of the company. So association clause clearly indicates that the members of the company have agreed to be able to associate with the company as the member. So they'll be able to maybe sign the memorandum. So by signing the memorandum, they're actually able to agree to associate and be members of the company. So that is what will actually be contained in what we call a memorandum of association. A memorandum of association. That is what will be contained in a memorandum of association. So I want us to look at the articles of association. I want us to look at the articles of association. Articles of association. So these are basically the rules and regulations governing the internal affairs of the company. It's like the constitution of the company. So the company won't just run its activities. It must have procedures put in place. It's like the constitution of the company. So it is basically a document containing the rules governing the internal affairs of the company. It's a document containing the rules governing the internal affairs of the company. So that's what we mean by an articles of association and articles of association. So we said that when you are registering the company, there's actually the option either to prepare your own articles or basically use the model articles of association under the Companies Act. So if a person is preparing special articles, so if special articles are being prepared, so requirements for special articles, what are the requirements for special articles? So if you are preparing your own articles, what are the requirements in this case? So the requirements will be that these articles should actually be printed and be in an English language and be in an English language. Then number two, these articles of association should actually be divided into paragraphs. The articles should be divided into paragraphs, should be divided into paragraphs, should be divided into paragraphs, should be divided into paragraphs. So another thing, the articles should be dated. So they should be dated. They should have a date under which they were actually prepared. And then the articles should be signed. The article should be signed by the subscribers to the memorandum of association, or those who have actually basically agreed to be the first members of the company, the subscribers to the memorandum of association, or those who have basically agreed to be the first members of the company. So saying this particular article should actually be in an English language and actually printed. Then the article should actually be divided into paragraphs. So this is actually basically if you are not actually using the model articles under the Companies Act, So if you are not using the model articles under the Companies Act, this will be basically be the requirements for the special articles that are being prepared by the companies. Then maybe you can just add the last one. So the article should be prepared in conformity with the requirements of the Companies Act. So they should be prepared. They should be prepared in conformity with the requirements of the Companies Act, with the requirements of the Companies Act. Remember, this is the law that is actually regulating operations of companies. So you can't just come up with your own rules governing the internal affairs without having to basically maybe check what are the requirements with regard to the law, So those will be part of the requirements if the company is to prepare its own articles of association. So what are the contents? What will be contained there? What will actually be part of the contents of an articles of association? So these articles of association basically will contain information such as the different classes of shares. So different classes of shares. So the contents of the articles. So different classes of shares. And their rights. What do you mean by classes of shares? Let's say, for example, preference shares. It will clearly indicate what are the different classes of shares in the company. We have preference shares, ordinary shares. So those classes of shares and their rights, and the rights attached to those shares. Number two, what will actually be contained there is the procedure of making calls and forfeiture of shares, for example. Procedure of making calls and forfeiture of shares, Procedure of making calls and forfeiture of shares. What do you mean by making a call? A call is simply a request by the company for any person who has not actually paid any amount, or for a person to be able to pay any outstanding amount on his or her shares. Let's say, for example, on allotment, you are allowed to pay 70%. So there is remaining 30%, which you must actually basically be able to pay when the company makes, for example, the first call. So by making that call, they are requesting you to pay the balance on the shares that have been allotted to you. So when they make a call, they must follow certain procedures. So they don't just make the call. So you'll see those particular procedures or requirements when we'll be looking at the topic of shares. By forfeiture, Forfeiture is basically cancellation of shares of a person or a member of a company in case he has actually now basically failed to fulfill the obligation under a call. For example, if they make the call and you don't pay the amount, if the company has been allowed under its articles, it can actually be able to forfeit the shares or cancel out the shares. So another thing that will be contained in the articles, procedure of transfer, procedures of transfer and transmission, procedures of transfer and transmission of shares, procedures of transfer and transmission of shares. I think that will be contained there, procedure of appointment of directors of the company, procedures of appointment and removal of directors of the company, appointment and removal of directors of the company, removal of directors of the company will actually also be contained there. Another thing that will be contained there are the voting rights of the members of the company, the voting rights of members of the company, voting rights of members of the company, voting rights of members of the company will actually also be contained there. Another thing that will be contained there is the extent to which the articles are applicable, the extent to which the articles are applicable, I think that might actually be contained there is the procedure of alteration of the articles themselves. So what is the procedure of alteration of the articles? Procedure of how the articles can be altered, procedure of alteration of the articles of association, procedure of alteration of the articles of association, procedures of alteration of the articles of association themselves. How do you alter them now? So they'll give procedures there. So this will be part of the contents or what will be contained in the articles of association, in those rules governing the internal affairs of the company. So this will be part of the major contents that will likely be contained in the articles of association. So talking about alteration, sometimes the company can decide to alter its articles of association. So they can decide they are going to be able to alter their articles of association or change their articles of association. So they can be able to do so by freely passing what we call a special resolution. So clearly try to explain what is a special resolution. It must actually basically be approved by at least 75% of the members of the company who are allowed to attend and actually vote at such kind of a meeting. So the rules governing the internal affairs of the company can only be altered if it has been approved through what we call a special resolution. So not by a simple majority, not by an ordinary resolution. So once the articles have actually been altered, it is a requirement that they be submitted to the Register of Companies 14 days after their alteration. So after the passing of this particular resolution to alter them, then the company should actually be able to ensure they have remitted it to the Register of Companies. It is important to remit them because remember, when you are registering the company, part of the documents you submitted there to the Register of Companies, it was an articles of association. But of course, this document, you've altered it. So you must actually be able now to update your record at the registrar's office, such that even if they are to basically carry out investigations or someone wants to know more about the company, the record at the registrar's company will actually be up to date. So it is a requirement under the Companies Act. So once the resolution has been passed of altering the articles of association, what do you mean by altering? Let's say, for example, they have changed a procedure in terms of appointing a director. They have altered the articles. They have changed these rules governing the internal affairs. They have altered procedures, let's say, for example, of making a call. It's not the same as it used to be. So they have altered it. So once they alter it, and they can only be able to alter it through what we are calling a special resolution. So members of the company, wale wenye kusema kwa kampuni, members, yani owners, yani shareholders, wale wenye kusema kwa kampuni lazima waamue hiyo kitu kwamba wanaweza alter. So the company won't just wake up one day and they just alter it. Wenye kusema kwa kampuni ndio watapitisha kwamba at a general meeting through a special resolution those procedures can be altered. And once they have altered, the point is this, that should actually go home. The point that should actually go home, they must remit to the Registrar of Companies within 14 days to update the records at the Registrar's office in terms of the rules governing the internal affairs of the company. So you're saying it is important because in this case, for example, if there's a person who has to do a search and wants to know more about the company, that these particular documents will have actually been updated, and therefore he'll get an updated record at the registrar's office. So maybe that particular point will come home clearly when we talk about the doctrine of constructive notice, which we are just going to look at after maybe looking at the articles of association. So we are saying these articles can be altered, but of course there are restrictions in terms of altering the articles. So you don't just alter them in any way you want. There are certain restrictions that have been put as to how the articles can actually be altered. So the alteration, for example, must not be inconsistent with the requirements of the Companies Act. So you shouldn't alter the articles in such a way that that procedure you are coming up with, it is not actually as per the requirements of the Companies Act, because you are saying when you are preparing these articles, the Companies Act should actually be able to guide you. The law basically governing companies in Kenya should actually be able to guide you. For example, if you are crafting procedures of appointing a director, you don't just come up with your procedures from the head. You basically look at the law. What does the law say in terms of appointing a director in a company? So you craft the procedures as per the requirements of the Companies Act. And of course, if you are altering the same procedures of appointing a director, you shouldn't actually alter them in such a way that that particular alteration is inconsistent with the Companies Act, because that is the law regulating operations of companies. So part of the restrictions, let's say, for example, number one, it could be, it is actually that such an alteration should actually basically be inconsistent with the requirements of the law. So maybe you can just go through those particular restrictions. There are like 10 of them. Then we'll be able to look at a past paper question and you'll be able to see why is it important for this particular alteration to be as per the requirements of the Companies Act. So maybe I'll be able to share something here. So restrictions with regard to the rules governing the internal affairs of the company. Restriction number one, the alteration must not be inconsistent. I hope you can be able to see there. The alteration must not be inconsistent with the express provisions of the Act, such as to restrict a member's right to petition for winding up. So that particular right is under the Companies Act. A member of a company can actually be able to go to court. By petitioning, they mean you can be able to go to court and, of course, argue a case that the company should be liquidated. That right, you have it from the Companies Act. So they shouldn't actually alter the articles. Let's say, for example, in terms of the procedures of winding up the company. And of course, they basically restrict you as a member of a company, and they say that a member of a company cannot petition for winding up of the company. Such a procedure is actually inconsistent with the most superior law, that is the Companies Act. And therefore, such an alteration won't actually be valid. So when they're altering the articles, they must actually always be consistent with what is actually contained in the Companies Act. So such an alteration won't actually be valid. Let's say, for example, number two, authorizing a company to purchase its own shares. So we'll see later on that a company cannot buy its own shares. So the companies are normally restricted. We'll see the reasons as to why that is important. Number three, authorize payment of dividends out of capital. You know what we mean by dividends. Dividends is basically what you gain by being a shareholder of a company. So how do you get dividends? Dividends is normally distributed from the profits of the company. For example, if Safaricom makes profits, let's say, for example, 60 billion, they'll put aside part of those profits to distribute as dividends. And of course, dividends can only be paid out of the distributable profits. You can't pay dividends out of capital. You can't get money from the share capital and actually decide you're going to use it to pay dividends, because basically that is like depleting the share capital of the company, depleting the money that is running the company. So how do you go there and actually get money from there and you decide to pay dividends? So under the Companies Act or under the law, it is not actually allowed for dividends to be paid out of capital. It can only be paid out of the distributable profits. So if you do such an alteration whereby you are saying that the company is going to pay dividends out of capital, that is not valid because the superior law, that is the Companies Act, does not actually allow for dividends to be paid out of capital. So alteration should actually always be consistent with what is actually in the Companies Act, because the articles of association is actually subject to the Companies Act. Number two, alteration must not produce conflict between the articles and the memorandum of association. If such actually happens, the memorandum will actually prevail. What do you get from that? What you should actually be able to get from that? The memorandum is superior to the articles of association. The memorandum is superior to the articles of association because they are saying anything that will be inconsistent with what is actually in the memorandum will actually prevail. So the memorandum is actually very superior to the articles of association. So any alteration should actually basically be inconsistent with what is actually contained in the memorandum of association. Number three, the alteration must not sanction anything that is actually illegal. So maybe you are basically coming up with a procedure that is basically leading the company to basically carry out illegal activities, outlawed activities like under the Constitution. So it simply means that such an alteration won't actually be valid. Number four, alteration must not be inconsistent with the order of a court. That's where the court has made an order to prevent oppression of minority members. The company may not alter the articles in a manner that will be inconsistent with the order of the court. So the court can give out certain orders to the company. And when the court gives out the orders, they must actually be followed. So if the company fails to follow the orders, then it simply means that they are not doing the right thing. So if you're altering the articles, don't do anything that is actually basically inconsistent with what the court has actually been able to order. Let's say, for example, not to oppress the minority members of the company. What we mean by minority ni wale wako na shares tu kidogo kwa kampuni. So hao wanaonekana si important kwa kampuni. So they are minority. So wale majority wanataka kuwakalia. So if the court has basically given out an order to protect the minority, so it simply means that if you are altering the articles, you must actually be able to observe such a court order. Number five, alteration must be made in good faith and in the best interest of the company as a whole. And if this is the case, it does not matter if it inflicts hardship on the minority. When you're altering the articles, it should actually basically be in the best interest of the company. Even if it will basically inflict hardship on the minority, it doesn't matter. And that particular case law down there will basically bring now the point home as to what they mean there. Like in this case, Side Bottom versus Kershaw Limited, what happened? The directors of the company held the majority of the shares. The company altered the articles so as to give power to the directors to require any shareholder who competed with the company business to transfer his shares to the company. It was held the alteration was valid as it was made in the best interest of the company as a whole. What they mean by this, there's a shareholder in the company, amefungua kampuni ingine ina compete na kampuni yetu. Sasa yeye akona interest the kampuni yetu ama ile ameform ambayo inatunyang'anya biashara. Even if the majority members decide that such a shareholder should actually exit, it won't basically matter because that decision is being made for the best interest of the company. This shareholder doesn't have interest in our company. He's running another company that is basically competing with ours. Even if we basically decide that even if he's a minority shareholder, it won't be taken as inflicting hardship on this particular shareholder. Even if it is in such a case, it is for the best interest of the company because he doesn't have the company at heart. He's basically running a competing business. He wants our business basically to go down, or basically our company to be shut down. Anatunyang'anya biashara. So when it is actually made in the best interest of the company, it doesn't matter whether it actually inflicts hardship on a minority member, because in this case, like this was like inflicting hardship on a minority member, basically forcing that member to sell his shares to the company and basically exit as a shareholder. But if you look at the circumstances surrounding that particular situation, it was for the best interest of the company. So if it is being made in the best interest of the company, it doesn't matter whether it is actually inflicting hardship on a minority member. Number 6, alteration to increase the member's liability will only bind those who consent to it. Thus, under Section 24 of the Companies Act, no member is bound by an alteration to alter a memorandum of association or articles which requires him to increase his shareholding or increase his liability to pay money to the company unless the alteration was made before he became a member or he agrees in writing to be bound by such an alteration. So this is what I was talking about, increasing a member's liability. You can only be able to increase the member's liability in the articles, of course, only if that particular member has consented or accepted to it. You can't just wake up one day as a company and decide you are going basically to increase the liability of each and every member in this company without the consent of the members. So if you're altering the articles in that regard, whereby you are altering the liabilities of the members by increasing, each and every member in that particular company must actually be able to consent to it. So if they don't do such, it simply means that such an alteration is not actually valid. Number 7, the alteration must not constitute fraud on the minority. The alteration to the articles would be declared invalid if it amounts to fraud on a minority member. In Brown versus British Abrasive Wheel Company, the majority passed a special resolution altering the articles so as to enable the majority, that is 9/10 of the shareholders, to buy out any other shareholder. It was held the alteration to the articles could be restrained as it was designed to allow the majority to compulsorily do what they could not do by an agreement. So they are forcefully basically acquiring the shares of a minority member, the majority shareholders. If such actually happens, and of course this member does not consent to it, it will be seen as being a fraud on the minority. So they are conspiring against this particular minority member to acquire his or her shares forcefully. But remember, there's another point up there. If it is being made in the best interest of the company, then such an alteration will actually be valid. It will be valid. For example, if this particular minority member was actually basically carrying out a competing business, then that decision by the majority will actually be seen to be valid. Number 8, where the alteration affects class rights of members, then the class right variation procedure must be followed, in which 15% or more of the decisions must be given a right to petition to the court against the alteration. So I know this one you've not understood it, but basically it talks about class rights. What do you mean by a class right? A class right. So we have classes of shares in a company. So let's say, for example, we have ordinary shares, we have preference shares. So ordinary shares, they have their own rights in the company. Preference shares, they have their own rights. Let's say, for example, for preference shares, they get what we call preferential treatment in terms of, for example, getting dividends. How do you lipwa dividends kwanza before even the ordinary shareholder? So that is a right they enjoy. Another right they enjoy, let's say, for example, they get their dividends at specific rates. So their rate is normally specified. So that's when you look at, for example, at the balance sheet, sometimes you see, let's say, for example, 6% preference shares. So their dividends is actually at the rate of 6%. So their dividends is normally actually at specified rates. So that is a right they actually enjoy in the company. So if this class right is to basically to be altered in the articles of association, because we are saying in the articles of association, there's basically what we call the different classes of shares and their rights. So let's say, for example, in those particular articles, we have preference shares as a class of shares in the company, and their rights are listed. Part of their right is, number 1, enjoy dividends in the company at 6%. So let's say, for example, in this case, the company wants to alter that particular provision, whereby they are going to alter the dividends. They can't just alter unless our class, our preference shares, they have been involved. And of course, they'll basically be able to follow a procedure that is laid out under the Companies Act, whereby those members of that class of shares must be able to meet and actually approve of the variation of that particular right in the company. So before the company alters in the articles, those members of the class of shares must meet. Those who hold preference shares in the company must meet and actually approve that particular alteration of that particular right in the company. So once they have approved, then now the company can actually be able to go ahead and actually alter in the articles. So they should not actually just alter the articles in terms of the rights of the members of a class of shares without involving the members of that particular class of shares. So we'll still look at that particular procedure later on under meetings. So we'll be able to understand it more. Then number 9, alteration may not be made to have a retrospective or backdating effect. Let's say, for example, if we passed a decision to alter the articles today, that is, let's say, for example, on 23rd of January, 2022. But of course, now we backdated to 2021. So such can't actually be allowed. So it cannot actually have a backdating effect. It simply means that that alteration will apply from 23rd moving forward, not to backdate it and say it will apply for us for the last 3 months, or maybe from 1st of December 2021. So it cannot actually have what we call a backdating effect. Then the last one, a private company which intends to continue enjoying the privileges of a private company shall not alter the provisions of the articles to conflict with Section 30 of the Act, which defines what is actually a private company, So a private company has a membership of 1 up to 50. It cannot invite members of the public to buy into its shares. So if it alters the articles for the company to be able to maybe do those requirements, then it won't actually be a valid alteration. So there's a question that was tested with regard to these particular rules governing alteration of articles. So I want us to look at that particular question. So the question is there. So it was tested in, the question was tested in 2019, May 2019. So the question is question number 1A. question number 1A, it says, the shares of United Limited, a private company, are held by Jane, John, and Alex. Jane and John hold 90% of the company's shares. However, they feel that the company is in need of further capital, but due to squabbles, they are not willing to inject additional funds as long as Alex still holds some shares in the company. Further, Jane and John believe that Alex has another business which is competing with that of United Limited. To resolve the problems, Jane and John propose to alter the company's articles of association by adding 2 new articles. The first article will enable the shareholders of 90% of the company's shares to compulsorily acquire the shares of the minority shareholders. The second article will require any shareholder who carries on a competing business with the company's business to transfer his shares to the nominee of the directors. Alex is aggrieved by the proposed alterations and comes to you for advice. Required, advise Alex on the validity of the proposed alterations to the articles of association. So that particular question was actually basically from the rules governing the alterations of articles of association. So you can see what they are saying in the second paragraph, how they are going to alter the articles. So number 1, what they are going to do first, the first article will enable the shareholders of 90% of the company's shares to compulsorily acquire the shares of the minority shareholders. The second article will require any shareholder who carries on a competing business with the company's business to transfer his shares to the nominee of the directors. So they are saying basically you advise Alex on the validity of the alteration of the articles. So remember there are these particular 2 points. Let me just show you again.